The national debt is a ticking time bomb, and it's only a matter of time before it explodes. The United States government debt has reached an unprecedented level, surpassing even the wartime highs of World War II. With a staggering total of over $34 trillion, the question on everyone's mind is, what does this mean for our future, and how can we possibly escape this financial quagmire? 1. Understanding the debt. The United States measures its debt by comparing the total economic output, known as gross domestic product, GDP, to the amount of money the government owes to the public. This ratio is crucial in understanding the country's financial health. Currently, the U.S. debt stands at approximately 96% of its GDP. This means that for every dollar the country produces, it owes almost $1 to its creditors. The government relies heavily on taxes to fund its various activities. These taxes are used to support essential public services such as education, infrastructure development, military operations, social welfare programs, and even interest payments on the debt. When the government spends more than it earns through taxes, it is forced to borrow money to cover the shortfall. This borrowing increases the national debt further, making it essential to manage finances wisely to avoid a debt crisis. The high debt-to-GDP ratio is a cause for concern, as it can lead to several negative consequences. For instance, high interest rates can make borrowing more expensive, which may lead to increased government spending and further exacerbate the debt problem. Additionally, a high debt burden can limit the government's ability to respond to economic downturns or invest in vital public services. Therefore, it is crucial for policymakers to implement effective strategies to reduce the national debt and ensure a stable financial future for the country. To address the issue, the government can consider various measures such as reducing spending, increasing taxes, or implementing policies that promote economic growth. By taking proactive steps to manage its finances, the U.S. can work towards a more sustainable debt-to-GDP ratio and maintain its position as a global economic leader. 2. How we got here. The United States has been facing a significant debt issue since the early 2000s. This buildup began with increased military spending for the Afghanistan and Iraq wars. The country's military expenditures significantly increased during this period, contributing to the growing debt. The situation worsened during the 2008 financial crisis, when the economy experienced a sharp downturn and tax revenues plummeted. In response, the government implemented various spending programs to stimulate the economy, further exacerbating the debt. The 2017 Tax Cuts and Jobs Act, TCJA, further reduced tax revenue, making it even more challenging for the government to balance its budget. The TCJA aimed to boost economic growth by cutting taxes, but it also led to a decrease in government revenue. This reduction in tax revenue, combined with the ongoing military spending and other government programs, resulted in a significant increase in the national debt. The COVID-19 pandemic has added to the country's financial woes. To mitigate the economic impact of the pandemic, the government implemented various relief programs, which required significant borrowing. These programs aim to support individuals and businesses affected by the pandemic, but they also contributed to the growing debt. The cumulative effect of these factors has resulted in a substantial deficit, where the government spends more than it earns and must borrow the difference to cover its expenses. In summary, the United States debt has been building up over the years due to a combination of factors, including military spending, the 2008 financial crisis, the 2017 Tax Cuts and Jobs Act, and the COVID-19 pandemic. These events have led to a significant increase in the national debt, making it essential for the government to implement fiscal policies that promote sustainable economic growth and reduce the debt burden. 3. Borrowing process. The United States government borrows money from the public by selling notes, treasuries, and bonds. Unlike borrowing from a bank, this process involves the government directly asking individuals, organizations, and investors to lend it money. These investors buy these bonds because they trust that the U.S. government will pay them back with interest known as the yield. This yield is essentially the rate of return that investors earn for lending their money to the government. However, as the U.S. debt continues to rise, lenders become increasingly nervous. If investors believe that the government cannot keep up with its payments, they might stop buying bonds altogether or demand higher yields to make it worthwhile for them to lend. This can create a vicious cycle where the government needs to borrow more money to pay off its existing debt, but lenders become less willing to lend due to the increased risk. This can lead to higher interest rates and a higher cost for the government to borrow money, making it even harder to manage its debt. The government's ability to borrow money is crucial for funding its various programs and initiatives. Without the ability to borrow, the government would have to rely solely on taxes and other revenue sources to fund its activities. However, the rising debt and the potential for lenders to become less willing to lend make it essential for the government to manage its debt effectively. This involves implementing policies that reduce the deficit, increase revenue, and ensure that the government can continue to borrow money at a reasonable cost. Ultimately, the U.S. government's ability to borrow money is critical for its economic stability and growth. By managing its debt effectively and maintaining the trust of investors, the government can continue to fund its programs and initiatives while also ensuring that it can pay back its debts in a timely manner. This balance is crucial for the government's long-term financial health and the overall well-being of the economy. 4. The ripple effect. The government's reliance on borrowing to fund its spending has significant implications for the economy. When the government needs to offer higher yields to sell its debt, it can have far-reaching effects. Higher yields on government bonds can divert investors away from riskier investments like stocks, leading to a shift in the market. This shift can cause interest rates on other financial products, such as mortgages and car loans, to rise. This increase in interest rates can make borrowing more expensive for individuals and businesses, which can slow down economic growth. A study from the University of Pennsylvania warns that if the government continues to borrow at its current rate, it could lead to a financial crisis in the future. The study suggests that if we continue down this path, we might reach a point of no return within the next 20 years. At this point, the interest on our debt would become so overwhelming that we would struggle to pay it back, leading to a financial crisis. This crisis could have severe consequences for the economy, including higher unemployment rates, lower economic growth, and even a recession. The consequences of not addressing our debt issues are severe and far-reaching. If we do not take steps to reduce our debt burden, we risk facing a financial crisis that could have devastating effects on the economy. This crisis could lead to higher unemployment rates, lower economic growth, and even a recession. It is crucial that policymakers take immediate action to address our debt issues and ensure a stable financial future for the country. To avoid this financial crisis, policymakers must take steps to reduce our debt burden. This can be achieved through a combination of reducing government spending, increasing revenue through taxes, and implementing fiscal policies that promote economic growth. By taking proactive measures to address our debt issues, we can ensure a stable financial future for the country and avoid the devastating consequences of a financial crisis. 5. Possible solutions. How can we get out of this mess? One way is through an economic boom, similar to what happened after World War II. Military spending dropped and the economy grew rapidly. Some hope that advancements like AI could spark another boom. However, with an aging population needing more social security and healthcare, this might not be enough. Another option is for the government to print more money to pay off the debt, but this would likely cause inflation, making the dollar less valuable and reducing our purchasing power. A third option is raising taxes significantly, which could burden future generations. 6. Preparing for the future. The United States government debt is unlikely to be paid off in the near future. This raises concerns about the potential for a financial crisis. To prepare for such an event, experts recommend investing in assets that tend to appreciate in value and are less affected by inflation. Real estate and certain types of bonds are often cited as good options in this regard. Another strategy is to explore international markets with strong economies. This can provide a hedge against potential economic downturns in the US. However, it's essential to note that this situation is unprecedented, making it challenging to predict the best course of action. It's crucial to stay informed and adapt to changing circumstances. Ultimately, the key to navigating a potential financial crisis is to diversify your investments and be prepared for unexpected events. By doing so, you can minimize the impact of any potential downturn and ensure your financial security. The U.S. government debt is a complex issue with no easy solutions. It's crucial to stay informed and make wise financial decisions as we navigate these uncertain times. Thanks for watching, and if you found this video helpful, don't forget to like, share, and subscribe for more insights on investing and money matters.